Hussbus bus stop. JP Hussey, owner of the Hussey Team Mortgage Advisors, with this week's Hussbus bus stop. Alright, today I want to kind of give you some education, alright, and then maybe give you a tip here of what I personally do. Because like we know in today's world, you got to make your money work for you. Alright? Tax increases, all that jazz. Alright? So, when you buy a home, depending on the product, usually this is only going to be allowed for conventional loans, usually not for FHA loans, maybe VA loans, I think you can. Don't quote me on that, but I think you might be able to do this. USDA, pretty sure you have to do this, but what I'm talking about is escrowing your taxes and insurance, all right? Now, conventional loans, let's start there. You can sometimes say, I only want to escrow my taxes, not my insurance, or just my insurance, not my taxes, both of them, or none of them, okay? And what escrow is, all right, in our world, okay, is the money that is in your payment, okay, per month. So basically it's your taxes, property taxes, insurance, whatever that yearly premium is, add it up, divided by 12, that's how much extra your payment is per month. That's the escrow portion. The other portion is the actual loan, okay? So it's a loan payment, which never changes unless you have some weird arm, okay? Fixed rate, never change. But then this other portion can change once a year, this escrow portion, because taxes usually go up. Insurance has been going up. So once a year, these servicers look at, if you escrow your tax and insurance, they look at everything. They have to collect your tax bills. They have to pay them on time. Every county and state is different in getting them the bills. A lot going on. There's mortgagee clauses if you change insurance. There's a lot going on there, all right? So that's what escrow is. It's that portion of your payment so the servicer can pay your taxes each year. And it's your taxes, insurance, add it up, divided by 12. That's all it is. Don't overthink it. That is what it is. Now, there's some things there's calculations that have to be done. If you buy a home or even refinance, of how much money needs to go into this account so they have enough of your money in there along with your payments each month, add it up for when things are due. So it can be a pretty crazy calculation. All right. Now, most people, let's say 80%, maybe more, people just do that. They say, I don't want to worry about it. I'm just going to get my routine of making my monthly payment each month and let the servicer pay it when they're due each year. Okay? That's fine. But these servicers, which they might collect your money, doesn't mean you got to go to them to do a refi or buy a home. They usually stink at it. Not all of them. Most of them do. But all I do, at least a couple times a week, is help out clients deal with the servicer because they've screwed something up. Okay? They pay out their insurance too quick and they're refinancing. There's all types of messy things that can happen, all right? Because there's a lot of moving parts. And they're not the best at it, let's say. I say, how about you control this situation and you make money on your own money to help, what is it called? I can't talk today, but counteract, if you will. Go ahead, Linz, make fun of me. Counteract tax increases and insurance increases each year, all right? So what I do personally and what I recommend is if you buy a home, all right, usually got to be conventional, like I said, all right? Do not escrow your taxes and insurance, all right? It's going to save you money at closing, even though you're already paying these taxes anyway, all right? Keeps your payment lower, but remember, we have to save to pay these tax and insurance each year. Pay it on your own. I'm telling you, do it. It's going to save you headaches down the road when the servicer screws it up, because at least once in your life, if you have a loan, it's going to be screwed up. I am telling you right now, and quite honestly, I'm sick of doing stuff and getting on the phone and helping people figure it out. Of course, I'll do it, all right? But that's time and money wasted, all right? So what I recommend is, and maybe I'll have Lindsay kind of put this up here, a little plan, all right? So let's go through it quick. Let's say you're homeowners. Let's do some math. 150 times 12. Let's say your homeowner's premium is $1,800 per year. Pretty average, I'd say. Okay, that's $150 per month. that would be in your payment if you escrowed. And let's say your taxes times 12,400 is $4,800 per year. That could be a little low, but let's say it's that if you're in like the contract and can't brush your area, tax is a little low. All right, so that would be, I don't know what happened there, that would be $550 per month. That would be in your payment if you escrow. And then it gets paid for you, okay? Now, do not escrow. What I suggest that you do is go open up a savings account that pays you on your money. Like a Capital One, for instance, that I have for one of my accounts, all right? I get 4%, all right, of my money that's in there. Every month, they pay me interest. They paying me interest now. You're not paying the interest, okay? Or a money market account, something that you can pull money from with no penalty, and you can pull whenever you want, all right? You want access to this money, all right? So what I recommend for people is let's keep the lower payment, just paying the loan. Now, you have to pay your tax and insurance when they're due each year, but you've been saving $550 per month or more. It's a kind of a forced savings, which is good. And then you're earning money on your own money. And then if your taxes or insurance go up, guess what? You've been earning money on that money, and you can pay that tax increase. Whereas if you escrow your tax insurance, your payment's just going to go up, and that's it. All right? And a lot of people say, hey, we're letting these people hold my money. They are probably making money on your money. So why don't you be your own bank? All right? So for instance, let's say you did only $550 per month at 4%. Now, this let's just say you had, if you add that up, it's $6,600. All right, let's say you had that in the beginning. So once you build it up, this is what the number is going to be. But that's going to be about $26, $27 per month that you would earn in interest with at least $6,600 in there. Okay, or $360 per year. Right. Taxes go up about that much per year. So now you're counteracting it. You're making money your own money. And guess what? If it's $550, if you can do it, do $600, do $700, do $1,000. Save money. Make money on your own money. Have access to it. Of course, speak with a financial advisor. But this is just for no escrow loan, so you can pay your tax insurance and you don't get caught with having to pay a big lump sum each year. But don't forget, you're paying it anyway if it's in your payment. So why don't you control it, earn money on your own money, and have less headaches, quite honestly. Later. Hussbus, bus stop.